Hey guys, welcome to this week's Money and Investing Show. This week we are talking about the subject of hedging out downside risk. A lot of people that are long-term investors kind of shrug this off and just say, we'll ride the market out. But as you'll hear in this training session and what we're covering in the podcast, that can be a very, very expensive mistake to make. Buying some protection, making sure you're immune and insured against some of the uncertainty that could be around the corner will give you more peace of mind than you can possibly imagine. Take plenty of notes, and as always, make sure you take plenty of action, and I'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter.
Buddy?
I'm very well, thank you. Well dressed.
Thank you.
Looking nice. I want to get a how-to, and it's not a how to dress as nicely as you, unfortunately. It's more related to markets this time. I want to talk about how to hedge a portfolio, what that means, and what are some elements and ways to do that. Important topic of conversation considering the current environment.
Absolutely. And, you know, people divide themselves and typecast themselves if they've got stocks in the marketplace. Some people consider themselves to be investors and they're just in it for the long term and will just hold and ride it out. And other people perhaps are a little bit more nimble. It would be what you describe as a trader, a little bit more active in the market. And this is the sort of place, that these conditions tend to pull those, into hedging. So just as a point of note, why is hedging so important? Then we'll dive into what it is. If you're an investor, a buy and hold investor, and we've all seen markets pull back. You think about the GFC or the tech boom and bust. Markets recover. They do get back up to those previous highs. The challenge is it can take quite some time, and specifically, and I've had a couple of people debate me on Facebook about this, but the statistics and the facts speak for themselves as always. It actually took the stock market in Australia 12 years to recover from the GFC, to get back to those pre-GFC heights.
That's a long time just to get your original investment back.
Absolutely. Imagine you're in transition to retirement at that stage, or in the case of the dot-com bust way back in 2000, it was 15 years before the NASDAQ recovered those previous highs. So the notion of I'll just buy and hold and markets always recover is a statement of fact. The challenge is the dead time where your money has effectively been euthanized for a decade plus in both of those cases to recover. So rather than go through that pain, and our goal isn't to take someone that's an investor kicking and screaming and dragging them into this dark room into the world of trading, but maybe to give them some more proactive tools to soften the pain of a market correction.
And I think it's an important conversation to have. We've got a lot going on in markets right now, as we have had all year. So just before we dive any further, AB, can we get a definition for our listeners out there on what is a hedge? Okay,
so in its purest form, a hedge is a position that you set up on your portfolio that in the event of your portfolio dropping in value, and that would be a market fall for most people, the mechanism that you've put in your portfolio would profit from that fall in the market. And the purpose for the hedge is that, if the portfolio shares you've dropped by, say, 10 or 15%, the hedge that you've put on would gain by 10 or 15%, and net, they square each other off. And even though the market may have dropped, your portfolio is still worth in dollar terms what it was pre-correction.
Hedging your bets, so to speak.
So you're just putting in play, I guess, a marker to say, I'm not going to get exposed to the downside here. I'm now protected from it. There is a trade-off to that, and that's the fact that you also don't get an exposure to the upside, because if in fact markets move higher, the value of your portfolio is going to increase, but the value of what you've bought as your hedge is going to decrease. And so the gain on one side will be offset by the loss on the other. So you're putting a line in the sand and saying, look, I'm happy given the current conditions in the market for my portfolio to be stable and be worth what it is today in 2 months' time, when maybe volatility drops down, and I might then choose to have a more confident directional view on what we're doing. So you're opting out of further directional view potentially. You don't have to fully hedge, and we'll get onto that later on, but you're opting out of any further directional move in the market, either up or down. You're just setting your stand out to say, this is it. This is where I'm happy holding the value of my shares or my portfolio.
Sometimes not a bad outcome considering what we've seen. So what are some mechanisms to hedge, AB? How can we break it down?
Look, they can be quite simple, and some of them can be fairly complex. Looking at the more complex, in the first instance, shorting the market. And you can do that using futures, for example, where you basically short the future, or you can short the equity market and the index. That is quite a high-level skill in terms of doing this. How do you do it? You sell something you don't own, which in itself is a head spin for most people that don't understand how these mechanisms work. And the goal is that you sell it for, say, $10 today, and if the market drops by 20% and it's worth $8 tomorrow, tomorrow, you buy it back for 8. If you sold something for 10 and bought it back for 8, you've just made $2.
Yeah.
You've just done it in the reverse order than someone that bought shares at 8 and sold them for 10 hats. And it's possible to do that with a number of financial instruments out there. As I say, futures is probably a little bit more towards the more sophisticated end for a lot of people. Once you understand, it's also one of the easiest ways of doing it, but nonetheless, it does require a high level skill. So that's a way of doing this. But moving perhaps along the line a little bit to something that's a little easier, still complex in some respects, but also very, very powerful. And that's the notion of using put options. So you can buy a put option for want of a better description, I'll be very careful because a regulator absolutely hates it if you say you've insured your shares, but the reality is you have insured your shares, you just can't call it insurance. So by buying a put option, you've bought a protection over your shares, which is very, very, very similar to having them insured. So let's say BHP was trading at $40 and you're worried about the outlook for BHP. You could buy what's called a $40 put. And what that does as the owner of that put, it gives you the guaranteed right to be able to sell BHP shares for $40 at a point in time in the future. So if BHP drops to $30, legally and guaranteed, you can still sell your shares for $40 because you bought that insurance policy.
Obviously, the downside is, though, of course, you've got to outlay money to purchase that policy, right?
There are a couple of downsides to that. Number one, put options work over a finite period of time, so there's an expiry. So you've got to pick a time window that suits your view. So you might say, look, I want to insure for the next 2 months. And if you want to insure for 2 months, it's going to be cheaper than insuring for 6 months, just like your car. If you insure your car for half a year versus a year, the premiums are lower. Secondly, you're quite right. You do have to pay that money up to buy that insurance policy. So there is a cost associated with it. I'd also argue that's a peace of mind tax that is well worth paying. I know, again, just for a bit of controversy and opinion on here, and feel free to go talk to your accountant about this. I've seen and had clients in the past that have used the cost of a put option as a tax deduction purely and simply because it's ensuring the value of their portfolio. Just like if you were a landlord and you bought a building or you had a house and you had building and contents insurance, that's a tax deduction for you as a landlord. So
I did not know that. There
have a conversation with your accountant. I'm by no means suggesting you can claim it, but it's a conversation that you might want to have with your accountant because to all intents and purposes, it's the same.
Got you. So put options are a really good way. That's something that we use often on our trading desk.
Yeah, and these are very nimble too. You can be in and out of those quite quickly. Some of the downsides to that is that the time when you want to buy insurance is usually a time when circumstances are a little bit rough. And the challenge, of course, like any good insurance company, is when you want to buy insurance, if the conditions are rough, they're going to charge you a higher premium to reflect the choppiness in the economy or the market or the stock. So you can pay a little bit. So sometimes you're better off buying that insurance during the calm before the storm.
Absolutely.
And get that insurance a little bit cheaper, maybe for a little bit longer, and protect yourself that way. So put options can be a very, very useful tool in that regard.
And you can also sell that insurance policy back to the market when it's worth more too. That's something to consider.
Correct. So you don't necessarily keep a hold of it and exercise that insurance policy. You're more than free to trade that in the marketplace too. So you can make some good gains on that. Again, the whole purpose of it, though, and I think, Mitch, it's really important to differentiate. If you're looking to hedge, what you're looking to do is to protect the value of your portfolio. If you start getting into the notion of buying a put option and trading around it, you're now taking a directional view where you're actually trading and looking to capitalize and profit from a falling market versus someone that's just simply trying to protect themselves from it.
It's an important difference.
It's a subtle line, but it's an important one to acknowledge, yeah.
Got you. Well, let's move on now. What about our favourite one, and arguably the easiest to understand? That would be buying a short ETF.
Yeah. So trying to go into the futures market yourself, if you're new to this, or working out which option strike and which expiry to work on the back of, et cetera, that can all be quite challenging. Going into the ETF space, it's almost like an easier option in that the work is done for you behind the scenes by the manager of that ETF. So if you had a nervous and bearish view on markets, if you're looking at the Australian market, you might buy the exchange traded fund BEAR, BEAR, which if the Australian equity market drops, the value of BEAR increases. It's on a correlated basis. So 10% drop there, 10% gain over there, net, you find yourself square. You've only got one transaction to do. It's very simple. It's reasonably liquid, and there's a lot of buyers and sellers in there, so it's easy to trade. And that's a very simple meat and potatoes way for anybody listening to this that owns a portfolio of shares that's worried that there may be some downside to come, where they can get the peace of mind and protect themselves from that downside.
And you can do this across both the Aussie and the US markets, as we know.
If we were looking at the US market, SH on the S&P 500 or the PSQ on the Nasdaq, exactly, would be good places to go to protect yourself if you've got US stocks or you've got a bearish view on the US market. Where I think people can come unstuck sometimes with ETFs, we talk about a pure hedge, which is what we've just spoken to there, is where you start moving into geared ETFs. So, you could do SQQQ on the Nasdaq or BBOZ on the Aussie market to get a geared exposure to that downside view. And for someone that's brand new to this, I'd probably not suggest that you go down that pathway, because you're just adding some high octane fuel to something that's quite likely to move fairly quickly. That said, and I guess as we move into the next part of this conversation, well, how much of the portfolio do you hedge?
The magic question.
If you've got, $100,000 in the market, do you hedge that whole $100,000? Do you hedge a partial amount, half of it, 20%, 10% of it? And sometimes it comes down to how much spare cash that you actually have. So let's say, you're largely fully invested and you've only got $5,000 out of 100,000 to hedge. We've only got $5,000 to work with. So if you buy a short ETF, SH or PSQ or Bear, you're only ever going to be able to buy a fairly small amount of it. It was only going to be a very small part of the hedge. And this, I think, is where geared ETFs can add some value, because if you've got an ETF like SQQQ that offers double or triple gearing to that downside, well, that $5,000 worth of hedge is now $10,000 worth of hedge. So that's a valid case. You got to be along the line in the journey before you start tapping into those kind of tools. You're trying to sort of get into a Formula One car when you probably should be in a Prius for a lot of people. So you just want to make sure that you don't, get too excited with these sorts of things.
So the question may be, how do you work out what amount you should be hedging?
Yeah, it comes down to like your strength of view. I mean, if you feel that you're in for a big leg down in the market, I guess the obvious question is, well, why don't you just sell your shares? And whilst it's very simple to say that, from an emotional point of view, a lot of people struggle with that decision, because trying to time the market is notoriously difficult. People typically don't have access to some of the tools that we've developed in our trading lab. Things like the signal screener, for example, which has been a very good tool. On when to get in, when to get out. Also, the notion of selling shares. A lot of portfolio clients, a lot of investors out there that have got a decent long-term portfolio, were they to sell their shares, the capital gains tax liability is really quite substantial. So, and if you're not structured in the right way and your capital gains tax is 50%, that's a pretty decent haircut to take. So I can understand your reluctance for saying, well, look, I think the market's going to drop by 10, 15%. I don't really want to sell my shares, though. I don't want the 10% drop in their value, but equally I don't want to have to pay the ATO 50% of the gain I've made out of this stock that I've held for the last 10 years, 12 years, whatever it might be. So in that instance, using a hedge makes an awful lot of sense. As I say, if you're an investor, don't be closed to this. You should be listening to this so that you've got the peace of mind and confidence knowing that your shares are protected to the downside and you're avoiding that notion of having to liquidate and then pay tax.
And I guess to add to that, AB, if you're a long-term investor and your view is that markets go up generally over the long term, which we know they do, why sell your shares in the short term when you've been holding them for the long term, when you can simply just buy and sell an ETF, as you mentioned, over a short period to capitalize on that?
And I think that sort of active management of a passive portfolio makes a lot of sense. So, turning back to the question, how much do you hedge? Depends on how strong your view is, how much cash you've got to work with, what the nature of your portfolio is. Are there capital gains that you're trying to avoid realizing, or is it an actively traded portfolio? And again, that comes back to making sure you kind of have your structure sorted out early on in the piece before you sort of build your wealth up too much. But hedging, it's a crucial skill. You can't have serious money running in markets. And there's an interesting term, isn't it? Serious money. What's serious money? Well, everyone's money should be serious to them, whether it's a $5,000 account or a $5 million account or beyond. Managing it prudently is how you turn it into a bigger account, not a smaller account.
Got you. For our listeners out there, AB, what I'd really love to hear, I'm sure as everyone else would, a situation that you've had in the past in your career where you've seen a context or a situation where you felt like you needed to hedge, what you did to hedge the portfolio and how it worked out.
Okay. I've bought puts on stocks quite frequently.
So insured your shares?
As I've insured my shares, and the advantage to that is that you can be very precise with that. There's a level of precision where you're not taking a market view. It might be on a particular stock to lock in gains. And this notion of managing risk or buying puts for protection, people think, oh, that's because the market's falling. But if you take an example, and this is going back in the mists of time, take Babcock and Brown, which we actually helped list. Was it 2005, 6, like a long time ago now. That was a stock that we listed at $5, and that stock had a run up to 36, $37, so 700% gain on it. And when you're up 500-600% on a trade, the natural thing is to, well, let's just take profit. But psychologically, that's quite hard to do when you're in something that's absolutely charging, and you think, well, this is going to be the next Macquarie. It's going to go to $100.
Agreed.
So we're going to hold on to this. But how do you hold on to it in a way that's prudent and a way that's sensible and stacks the odds in your favor for making some money? And in that instance, buying some put options on the way up. So, with the stock at $28, buying a Babcock and Brown $25 put. Well, if the share price drops down, I get the ability to sell my shares at $25. I only paid $5 for them, so I'm locking in a 500% gain. Happy days. So that's an example of hedging out the downside to protect profit, not just simply your capital. And so, once you understand that, falls in markets happen reasonably often, especially this year, and you've got the confidence and the skill set, the knowledge, maybe the support around you, the techniques to insulate yourself from that downside, whether that's confirming and locking in guaranteed profit, or whether it's confirming and locking in guaranteed capital values on your shares, hedging makes an awful lot of sense. That's an example using an option. I do use ETFs as well. I've got some bearish views on the market at the moment, so they're not so much hedges. They're more just a directional play, which I'm using ETFs for as well. If I go back through the dot-com boom, particularly, and then the subsequent bust, at that time, the market was a little bit different. And one of the tools, and if you've been around markets for a while, you remember these, was actually the warrants market. So I used warrants back then actually to form some level of protection. So on the NASDAQ, I remember trading those fairly actively. Also some options around it too on the index to protect positions. So yeah, it's a well-time tested strategy. It's not boring. It's not being scared. It's not running for the hills or bunkering down. It's just making sure that the profit that you've made gets to stay in your bank account and in your trading account, or it's making sure that you can sleep at night. And both of those are very valid boxes to tick. So it's not a bit nervous, better buy a hedge. Oh, poor you, do you want to go home and cry? No, I just want to make sure I keep the money that I've made.
Absolutely.
That's smart. And the alternative to that, I'll ride it out. And look, by all means, it's your money. Ride it out if you so wish to. Just remember that can take an awful long time to recover. And if you've had the foresight and the skill set to avoid that 12 years, imagine how euphoric you would be. Hey, my shares are worth what they were when I bought them. Oh, that's great. Back to break even. But you've taken 12 years to get there. And you think about what the cost of living does over a 12-year period, especially given the current inflationary environment. That's great that you've got your capital back, but what you can buy with your capital is probably about a third of what you could have bought 12 years ago. So you've lost 66% buying power. You got the moral win. Oh, broke even. Good on you. Go and do a lap, get the kazoo out, blow the horn, whatever you want to do. That's your choice. But you've lost 66% of your buying power. Why do you want to do that when a few simple steps of protecting yourself gives you that peace of mind and eliminates the risk of being in that unfortunate position where, yes, you've got your capital back, but your capital buys way less now.
Yeah, absolutely. There's never been more of a need to have this kind of discussion, AB. And I think for our younger listeners out there, we think about pre-COVID sell-off where the market wiped off 40%. In-house, we had that signal screen, a red box, where we undertook those hedging abilities. And gee whiz, did it look after us? It
looked after us, looked after our clients. And that's the power, I guess, of, having experience and some robust tools, and then not just the experience and the robust tools, but several pathways that you can go down to then protect your account and your portfolio. You think how hard you got to work for your money. And, this whole notion of trading and investing, you can understand why it's a head spin for so many people. So you go away, you go and you work pretty hard, you manage to save what you can after tax, and then you're going to deliberately take that after tax saving, a fraction of your income that you've busted your back to make, and deliberately expose it to risk in the markets. It doesn't sound that appealing when you put it that way. And that's why building in these kinds of skills to protect that downside are absolutely essential. Number one, it's going to make it much easier for you to invest if you know you can control the downside and manage it. And if you invest more, you'll grow more, you'll make more, you'll retire early, you have a better quality of life. So that's a well-trodden path. But just the psychological beat up that people go through, and I know from the GFC in particular, we stewarded our clients really, really well through that. And again, the September 11 attack's another example where the market was already in a bearish shape actually prior to that, so we had some protection to the downside. And then September 11, totally unrelated event, but they happened to come along and obviously kick the pins out from under the market. And listening to clients that we'd worked with and educated that had those positions in play, going, oh gee, that was lucky. And then on the other side of the business, in the pure stockbroking business, so we had our education clients on one side of it, and then we had generic stockbroking clients on the other. Listening to the stress levels for those other clients, particularly for someone that's approaching retirement. So let's say, here you go, you're about to touch down, you're retiring in 6 months' time, you've worked really hard, you've got a $500,000 portfolio in the market, it kicks out a nice income, hopefully using cash flow on demand to generate that income over the top of it. Then all of a sudden your $500,000 portfolio is worth $250,000.
It's tough.
You just had a 50% pay cut on what your retirement income was going to be. So that plan to retire in 6 months' time may not be happening now. And psychologically, that's crushing, because so many people, when they decide to retire, they've got that finish line in mind and they're kind of going to limp across and get to that line and then they're done. So they've already mentally clocked out. For someone then suddenly to say, actually, no, you're not done, you're going to have to go another couple of years. And it's a different example and it's a different analogy. If you go back to a sporting event, which was not so long ago, which was the Tyson Fury fight against Deontay Wilder. Deontay Wilder knocked down Tyson Fury, and to all intents and purposes, given that Wilder's one of the most renowned punchers in the fight game, it was like it was all done. And you watched him, he clocked off, he was doing his celebration in the ring, cheering his fans on. And then out of the corner of his eye, he sees the Terminator get up off the floor. Tyson Fury, the Gypsy King, gets up off the canvas, shakes himself down, and proceeds to start fighting him again.
Crazy.
Now, mentally, he'd already clocked off in that fight, because as far as he was concerned, he just won it, only to realise that his opponents just got up off the canvas and there's a whole fight ahead of him, and Fury won that fight convincingly, with a stoppage, and that'll go down in history. And the reality is, trading can be the same. If you've clocked off that you're retiring and then suddenly you've got to clock back on again, the psychological damage that does for people is very, very hard to get past. Yet it's so easy to fix if you use some of these tools. And again, I saw that first Twin Towers going down, GFC, saw it do a dot-com boom and bust. We saw it through the COVID crisis. Doubtless to say we'll see that this year with what's going on in markets too. So, there is a pattern here. Make sure you protect yourself. And these aren't just words and stories that we're using to fill up a podcast to take up our allotted time. There's huge value in this. Experience is a great teacher. It's even cheaper when it's somebody else's. And don't make sure that you pay a lot for your experience by blowing up your account through these choppy times. Take the cheaper option. Listen to what we've just talked about here. It's free on this podcast, and apply the knowledge that we're teaching you. Learn how to be able to protect and enjoy yourself. And it's the best investment you'll ever make. I think it's Warren Buffett, the best investment you'll ever make is in yourself. Invest, learn how to protect yourself. And when this downside comes along and you are immune to it, you'll be very, very grateful that you took the 25, 30 minutes to listen to us today.
Absolutely. Couldn't have said it any better myself, AB. Unashamed plug. How do our listeners out there get access to this kind of information?
Follow us through. We're all over socials. Hit us up in the bio on here. Also, AustralianInvestmentEducation.com.au. Register, come on to one of our training events, talk to our team. Don't leave it too long. This market's not going to hang around.
Absolutely. Well said, AB. Cheers.
Cheers. There you have it, guys. Make sure you use some protection and hedging if you want to keep your portfolio safe. I'll ask one thing of you, and that's if you know someone that's in the market that's at risk of losing money if the market turns down, share this podcast with them. Make sure they get this information, and maybe you might just help them avoid the pain of trading on a landmine in markets. We'll see you next week.